podcast. It's your host, C. Howe. I'm here with Eric Thompson, financial guru. He's the money man in the short north. A lot of people go to him for his expert advice. Thank you for coming in today.
Thanks, appreciate you having me.
Yeah, we're really excited to have you. There's been a lot of stuff going on Wall Street last couple of weeks. People are just kind of wondering what's going on and looking for good advice and sound advice. So before we get into everything, tell me a little bit about you, your company, and how you got started.
Absolutely. Well, I've been helping people invest their money for over 20 years now. I got started with a large national firm and spent most of my career actually at Wells Fargo before I started my own firm, Heroes Wealth, a couple years back. And I help successful individuals invest their money in a prudent, quality fashion, and so they don't screw it up and they get the best opportunity without undue risk.
Right. What made you transition from a big firm like Wells Fargo to go independent?
Well, I had hundreds of clients, but it was too many, and I couldn't focus on the ones that really needed and deserved my help, that had substantial worth and substantial things going on. And I wanted to slow down, quite honestly, and I wanted to kind of get away from some of the conflicts of interest when you're kind of employed and or affiliated with a major bank or Wall Street firm, and to be a independent fiduciary is just a much better setup when it comes to giving unbiased advice to clients.
Has it given you freedom to, I know there are tons of programs and tons of different opportunities for people, but I know when I did mortgages, we were kind of pigeonholed to have specific programs due to who we were working with in other banks. Does this kind of give you the independence to like kind of cherry pick and really find a niche for your clients or where you want to kind of put them in a direction?
Yeah, it absolutely does. It's not night and day. I still had an extremely wide array of solutions before I had my own firm, and I still stick to a lot of those same solutions. But there's also a lot of other things that, whether it's help advise a client on a real estate project, or be able to do a certain private equity fund or something like that, and place money elsewhere that maybe wasn't in the cards before. But the bread and butter of what I do, which is really just helping people prepare for retirement, invest in time-tested strategies, that hasn't changed.
Now, when do you feel that someone should start to kind of assess their finances? At what point in their life should someone really start taking the necessary steps?
So that's a great question, and I think that in your 20s, you need to be investing in yourself, in your education, in your career, possibly starting a business, and get that income going. And then after that's done, let's compare the difference between saving and investing. Saving is saving for a rainy day. Okay? I know people in the restaurant industry, the hospitality industry, and we didn't have just a rainy day last summer, but we had a storm that's just now hopefully coming to an end. And for people that in that industry whose paycheck stopped or dramatically reduced, if they didn't have some cash on the side, and I'm not talking about investing because stocks went down too during that day. So if you have everything in stocks, stuff drops and you lose your job, and then you got to sell stocks at the worst time. You want to have that ready cash, whether it's 3 months, 6 months, something like that. We don't know what the rainy day will be. We didn't know that COVID will hit. That's the whole point of having a rainy day fund. And then when you get and keep the debt down, live within your means. And this is basic stuff. But then when you got that handled, and you're ready to actually earn more than the 0.1% that savings accounts are making, then you're ready to invest. And I like to start with just broad-based mutual funds, just buy the market, track the top 500 companies out there. I have 2 boys, ages 11 and 6. So we go through a lot of Band-Aids in our house. Where's this going? Most people know that Johnson & Johnson is the largest producer of Band-Aids. When we run out of Band-Aids, we just go buy more.
Mm-hmm.
And investing in these big companies, I can sleep at night knowing that Johnson & Johnson or Walmart or, Apple or these big companies, they're not going anywhere. They may go down, scare us a little from time to time, but, I'm still going to go back and buy Band-Aids to CVS, which is another. So just own these big blue chip companies. Think of that as the main course. Build a base with that. And don't invest money that you're going to need in a few months for a car or for rent, God forbid, or something like that.
Mm-hmm.
Because, if you invested money exactly 1 year ago, you were down 30% in a matter of 3 months.
Yeah.
But it's been a year, and now we're actually come out of that, and we're up about 15%. If you bought the top 500 companies. So it only took a year. Sometimes it takes longer. But be willing, when you own the big, solid companies, or a fund that invests in them, which I prefer, as opposed to trying to pick individual stocks, just at least to start with. You can have confidence, you can sleep at night, and if it goes down, we'll just buy more. And now let's contrast investing with speculating and gambling, because that's what's been in the news a lot lately.
Yes.
And there's a lot of whipsawing, a lot of money has been made in a lot of very speculative areas. And I call myself an investment advisor, not a speculation advisor.
Okay.
So I'm considered a fiduciary over my client funds. So I don't get involved in penny stocks or pump and dump schemes,
right,
or cryptocurrencies. These are all very exciting, and some of these things are doing very well.
Mm-hmm.
But as an investor, I would not recommend you start there, because that's a little bit like going to the casino.
Right.
It might work out. I can't tell you if it's going to hit red or black.
Right.
But it's, in fact, I worry about that side of the investment. Just because it's simple and easy and you can hit a few buttons,
mm-hmm,
doesn't change fundamental rules of investing. That there's got to be something backing the share price, whether it's earnings or a dividend, or the likelihood of that happening with the company down the road. There has been a mass proliferation of what we call in the business pump and dump schemes through social media, through online chat rooms, and I'll use GameStop as an example,
mm-hmm,
because it was, I could have almost predicted how it was going to end, other than maybe the timing. But GameStop is sort of like Blockbuster Video was. Eventually they just became obsolete. People started streaming on Netflix, and
right,
well, GameStop is in retail malls, which are also becoming a little bit obsolete.
mm-hmm,
And you go and you rent video games or you buy used ones, where the kids nowadays are just going online. Well, a bunch of people on social media got together and decided that they were all going to buy GameStop simply to pump the price up, not because it's a good company.
right. Now, was that illegal for them to get together and claim?
It's a gray area. It's a gray area, and I don't know how it'll wind up, because you can say I think the thing will go up, but
right,
you don't really know why people buy it. If it's proved to be a collusion,
mm-hmm,
yes, I don't think it'll prove to be that, and I'm not sure if that's what they intended. They also wanted to punish some institutional owners that were on the other end of the trade.
Yeah.
And so, something that not a viable long-term business went from, $5 or $10 a share all the way up to $300 or $400 a share. This is crazy. I've never seen anything like it. And right about when you heard it was 2 and 3 and 400, what I worry about is the people that didn't want to miss out and bought it then. Because where is it now? 50?
Yeah.
It's probably just going to wind up where it was, because of the business is just not that viable. And so realize that when you read an article, whether it's in a chat room or a tweet or whatever it is, do you really know who's tweeting that? And you really know their reasons for if they own the shares, obviously they want it to go up. If they can get more and more people to buy, it'll go up and benefit them. And that's nothing new. Mm-hmm. It's just being more proliferated because of the access to media and to individuals we have. I do think investing apps, whether it's Robinhood or whether it's even Schwab, who I custody my accounts at Schwab, I think technology is great to be able to buy quality investments cheaply, easily, instantly. Mm-hmm. Link it up to savings accounts, invest little amounts, no minimums. That's great, but I know that there's a lot of people that have taken that to buying penny stocks and cryptos and things that they really don't understand the risks of. And that's kind of the environment we're in right now. It's certainly better than the opposite, where everything is
right.
is down. I mean,
right.
but those, just know whether you're investing or speculating.
Okay, so I know a lot of people were kind of up in arms with the Robinhood thing because Robinhood wouldn't let people dump their stocks. Now, what is the problem with that, and was that legal for Robinhood to do that?
Well, from what I know about the situation, again, this as a non-speculation advisor, but I do pay attention to the news. It actually was the opposite of what you said. It had gone up and up and up. These people were pumping it up, and it got to a certain price. I don't know if it was 300 or 400, but it was fairly close to the top. Mm-hmm. And Robinhood wouldn't let people buy anymore. Okay. And then maybe that's what you meant. So they, this group wanted to maybe even pump it up even more. I don't know.
Oh, okay.
But
so
now, is that legal for Robinhood? I'm not 100% sure. I would say yes. The reason why is because brokerage firms, be it Schwab, Robinhood, Merrill Lynch, whatever the case, they have to have adequate capital ratios, almost like banks do, to back loans and savings accounts and so forth. And yes, the shares are not owned by Robinhood, they're owned by these investors, so what's the big deal? Well, some of these people were buying the shares with borrowed money from Robinhood. We call it trading on margin, another kind of high risk thing that's going on right now. And so they had to raise capital. And they could not have more people owning one stock and a potential risk of their books with margin trading and so forth on the one stock until they raised more capital, which they did. And I think within a few days people were buying it. But at that point it peaked out and everyone knew it was just, all right, last to sell loses, and everyone started going the other way. And I'll tell you this, last, I don't know, summer or fall, there was a 20-something-year-old startup investor that got carried away with short-term trading, options, margin trading, these things that are leverage your account with borrowed money. It went bad on him. He committed suicide.
Oh,
His
wow.
parents found a suicide note, and along with these apparent losses that he owed. And this is an extreme example, but investing's not a game, and it can be fun and easy, and that's great. But know what you own, and build a base with solid investments. Mm-hmm. If you want to play around the edges with 5 or 10% of your money, that's fine. It can be fun. Mm-hmm. I won't lie. I have a little bit in some of those areas, whether it's Chinese electric cars or Bitcoin or a little bit, and they're doing really well, but I limit it to probably less than 5%. And I know that I can afford to lose that if it goes the other way. My own personal and most of my clients are in those time-tested companies, and those might average 7 to 10% a year over the long haul. We're hitting singles and doubles, but there's in Major League Baseball, there's a extremely high correlation between home run hitters and strikeout leaders.
Yeah, because the guys that swing for it.
Yeah, and when you strike out, you get depressed, and you just singles and doubles, build slowly. That's my philosophy. It's not exciting, but it's consistent.
So when someone does find themselves in a position to look for a financial advisor, what are some of the things that they should be looking for in the guy that they're going to go with?
Well, I think that most people come to me based upon what I call triggering events. They are about ready to retire, and there's decisions they have to make on taking their Social Security, drawing out of their portfolio. Maybe they inherited, some money, and there's enough money at stake to where they just don't want to screw it up. It's kind of similar to doing your income taxes. If you have a simple situation, get TurboTax. It's close to free, and you put your stuff in there, and it's easy. Mm-hmm. But when you get more complex things, whether it's just a lot of funds, or you're selling a business, or you're inheriting money, or retiring, and there's tax implications on various accounts, that's oftentimes when people seek out. Startup, if you just want to start to save for the future, absolutely, that can certainly be a triggering event too. I would say that make sure you're dealing with a fiduciary, and to be considered a fiduciary, the advisor is not allowed to accept product commissions, which can lead to conflicts of interest. They have to charge either an hourly fee like an attorney, or a percentage of assets fee. Maybe it's 1% a year, and it's flat, and it's not based on the investments. So there's no incentive to trade for commissions, or put in terms of high fee products. But so understand how they're compensated and their experience. Experience probably means more than certifications, just because you've seen so many situations. And ask about the types of clients you deal with, and if their situation fits. And there's just got to be a good fit.
What are some of the red flags? Because I know a lot of your business is pretty much based on word of mouth from your clients, kind of passing your name on in their circles, and people that have probably worked with you in the past coming back. But as a guy out here looking for a financial advisor, if I'm talking to a guy, what should be some red flags to let me know, like maybe he's not so much on the up and up, or maybe I need to do more background into him?
I would be wary of somebody who promises outsized returns, promises to beat the market on a consistent basis, has some sort of hot idea. I've been doing it for 20 years, and hot never stays hot, but consistency pays off. Most advisors are either affiliated with a major firm that has supervisory systems in place, or they're an independent RIA, either of which you can go to something called brokercheck.com, and we all have to report to that, and we all have to, the licenses we get, the tests we pass, certifications we have are all posted there. It'll show, I've never had any official client complaint, but if an advisor has, then, or any legal type history, that will be on there. So that's probably any criminal activity will be on there. So I think that's just, you got to go there just to make sure that they're registered, that they don't have a history of client complaints. I invest my clients' money like I do my own money. So and I can, other than, maybe playing around the edges a little bit, like I was talking about.
Right.
I think that's what is important, and usually can get that. Most advisors will meet, for free for half hour, 45 minutes, and just talk through the situation. Any pressure is bad too, honestly. You don't need to, they should be patient once you take your time.
Now, with your investing style, would you consider yourself more of an aggressive investor with your clients, or are you kind of like aggressive on some things, a little bit more reserved on others?
I think I have about half my clients are retired, probably over 60 years old, and most of them have to live on their investments. So we focus on more conservative things for those clients. You know, we have some boring things like bonds and guaranteed interest, type of things. We also have a good healthy portion of quality stocks. For people our age, that it's for retirement. And by the way, really the first place to start is check and see if your employer has a 401k or something similar, because a lot of times if you contribute to that, you'll get matching money for free. And I tell my clients I'm a nice guy, but I'm not going to match their investments. So if your employer can do that, start there. And know that that's a retirement account, though. It's age 59 and a half before you can take that out. Sometimes that's good, sometimes it's bad. So have both. For younger people, I'm not afraid to go 100% stocks. Some people would call that aggressive. But I don't like to go into a lot of speculative areas that I talked about before, even if there's a lot of money right now to be made, because I know it can end bad. And so if you rule out speculating, I think if people have long-term time horizons, I'm fine being aggressive. I just don't want to get caught up in. There's a fine line between being aggressive and speculative.
Yeah.
But I respect the client too. So if they say, I want, on a scale of 1 to 10, 10 being aggressive, if I'm normally an 8, and they say they want to be a 9 or a 10, I'll adjust a little bit, and vice versa.
Okay.
It's really about time horizon. I have retirees that are in their 60s. They have pension income, Social Security. They don't need their investments. It's for the next generation. We can be aggressive because we don't need to draw off of it. Younger people, let's say they may need some of it. We got to keep a little bit of that conservative, just in case.
Okay. In your history of doing this, what are some of the better returns that you've seen on investments?
Okay, so I'll give you kind of the range of what I will call, we'll just call it the market, an S&P 500 index fund, which is kind of the basis. You can have a really good year in that, could be 20-25%. I don't know what the record is, it might be a little higher than that even. But in 2008, it was down about 35%. That's a big range, even for what I would call not super aggressive. And so much investing is emotional control, because when it drops like that, sometimes people get nervous, rightfully so. You study the history, it does always come back, and so you just gotta, the worst thing people do, buy when things are hot, panic when things are low. That's how they kill their returns. Most years are not like what I just said. 1 out of 10, you might get a 20-30% year. 1 out of 10, you might get a negative 35% year. Mm-hmm. Most are going to be between, negative 5 and 15 type of scenario. The average over the long haul is 8 to 10, but there's differences, and that's why you have to have that long-term time horizon. Lately, especially on that speculative, we've seen some crazy returns. Bitcoin and these things are up 4, 5, 10 times. That's outsized. Of course, they can go the other way too, and we've seen that. When I got in the business, was in late '99, and anything with a .com after a name, for about 2 years, did nothing but go up, and then eventually there was winners and losers, and the good ones stayed, the bad ones went out of business. And there's a lot of startups right now. That's great. Innovation's great, and a lot of technology companies that are making the world an easier and better place is great. But some of the share prices got really outlandish. So I think an environment like this, you just gotta have to say, okay, these returns aren't going to keep going. They could go the other way. But when you get out on that risk spectrum, lately we've seen some really good returns, way more than that 7 to 10% average. But know that long term, with investments that have staying power, those are the returns to expect, 7 to 10% long term, with some deviations.
Okay. All right, everybody. This is Sean Howard. This is Eric Thompson. We're going to take a really quick break. Short North Podcast. We'll be right back. Thanks for joining us again and welcome back to Short North Podcast. I'm your host, C. Howe. And again, we're here with Eric Thompson, financial advisor. He knows his stuff. He's been nice enough to give us some time today to explain some stuff, explain what's going on in the market, kind of let us know what's out there and what to look for in a financial advisor. Thanks for being with us again, Eric.
No problem.
All right, so for the second half of the show, I'd like to get into a little bit of the cryptocurrency trend that's going on now and Bitcoin, Litecoin, some of that stuff.
Yeah.
What are your feelings and what's going on with that?
Yeah, well, that's a great question, and there's certainly been that's been in the news lately. I think it was just a couple of days ago. The CEO of Tesla, Elon Musk, put something like $1.5 billion of company
very
money,
large amount,
transferred it from probably just corporate holdings in a bank checking account over to Bitcoin, which is the largest of the cryptos by far. I did read the other day there's 1,600 cryptocurrencies out there.
Really?
I didn't know it was that big at all. Now,
Neither did I. Thought it was like
the top three are like 90% of it, with Bitcoin I think is well over half. My thoughts on that are, I firmly believe that the way we process funds and the move toward processing those digitally will continue. I know with a lot of these, especially with international transactions, even a wire transfer, it's not like the movies where one guy has a laptop on one side and one guy has a laptop on another, and they put the password in, 7 figures gets transferred like that. Even wire transfers can take days if you go from one country to the next and take forms. And I know a lot of the digital currencies are literally immediately. That's the one advantage. The blockchain technology behind them I don't fully understand, but I know there's a lot of truth to that technology, and in some cases it can be more secure because there's a chain of all the transactions. I would compare it a little bit to the electric vehicle industry. I don't know how long it was ago when Prius came out with a electric car, but maybe 15 years, something like that. We're still nowhere near the majority being electric, but it's slowly but surely happening. But it's going to take time. If I want to buy a car next week and I have money saved in a checking account at the bank or money in Bitcoin, and I go to the bank and on the way to the bank Bitcoin falls 10%, I no longer can afford my car. So the volatility of these is for that reason, it's going to take a while to be liquid and stable. The government isn't quite sure how to regulate it yet, but there will be some of that. But I think it's, the medium of exchange is here to stay, very similar to electric vehicles. That said, just because more and more people are driving electric cars, I'm not sure if the price of electricity goes up. So when you're investing in a currency, you're not investing in a business. It doesn't have earnings, a dividend, or even a product. So that's why I would consider that more speculation. Gold has the same properties in turn. That's the old-fashioned way of owning Bitcoin. And gold has not done nearly as well as owning the top 500 companies. I would think of it as, I'll give you a quiz question. Do you know how the San Francisco 49ers got their name?
From the gold rush?
Exactly right. In 1849, there was a California gold rush. Mm-hmm. And a few people got rich when they found gold. But a lot more people got rich by starting businesses that sold the pickaxes and the shovels to the gold miners. Mm. So there's a lot of financial companies, whether it's Square, which is a payment processing, PayPal now accepts Bitcoin. A lot of the big banks will probably start to soon. I think American Express mentioned something about it. They can benefit from the use of that as an exchange too. So you can benefit from owning the currency if the next guy buys it. And I think there might be an argument to be made to, if more and more businesses and people use Bitcoin and there's a finite amount of it, there could be an argument that it could go up for sure. But just know that it's a currency. And in 2017, it had a big run, and then it proceeded to drop about 50% in value, and then it made this next big run here over the last year. Sure. So just know there's a lot of volatility, and that's not really it's not a business the way I think of it. It's a currency, but it will absolutely, it's here to stay. I mean, that's for sure. It's just a question of getting it stabilized and matured. And you know, if your bank gets robbed, you're covered by FDIC insurance, and you get your money back. If you get hacked and lose your Bitcoin or lose your password to get your Bitcoin or whatever the case, so you gotta, you know, there's some risk there too. But it's the new thing, and I think it's here to stay.
So what would you say to the guy that's gung-ho about investing in crypto right now?
I would say that know what you're in, know that it's not a business, and you can be totally right on the industry and the use of digital currency over the next decades to come. But that doesn't mean it's going to go up in price necessarily, especially if it's had this big run. Just keep it to a portion of your portfolio that you can handle the volatility with and potential drops on. For somebody that's starting investing and puts half their money in crypto, I would be nervous. Putting 10%, hey, that's probably not going to kill. Not going to hurt anyone too bad.
Okay. Now, with investing, I know stocks, and then real estate is also a thing that I know a lot of people are investing in because God's not making any more land. So,
right.
So, do you often suggest real estate to your clients?
Yeah, absolutely. I like to have a balance between real estate and shares of companies. There's pros and cons to each. I don't think one is necessarily better than the other. I think that actually owning portions of each makes a lot of sense. There are two primary ways to own real estate. And the first is what most people are probably thinking right now, and you go buy a rental property and you go find a tenant and you do the background check and you hopefully collect rent and you fix the toilets and you do all that and maybe you buy another one and another one and another one. Mm-hmm. And that a lot of people have done well doing that. That's, you know, kind of like buying blue chip stocks. You just keep doing it. The biggest difference there is your time. You know, it takes 2 seconds to buy, 100 shares of an S&P 500 index fund. And it's not going to call you and need the toilet fixed or need a tax return done or not pay the rent. So if you're owning real estate directly, understand that it's not just an investment but a job, and you have to dedicate time to doing that. And it's very difficult, and I can attest to this personally. It's very difficult to do it on the side and dabble in it. So the next step on that is to have a property manager or a company that specializes in all the minutia, collecting rent and doing applications, do that for you. And maybe they charge 10% of what the rents are to do all that, but they handle it for you. So that's a middle ground. And the third, I said there's two. There's the third way to do it is the absolute simplest way, and that's buy shares, just like you buy shares of Microsoft or an S&P 500 fund, in what are called real estate investment trusts. These are publicly traded shares of giant landlord companies. So think about huge companies that own apartment communities, storage facilities, data centers are even considered real estate, warehouses. You've seen those big Amazon warehouses going up.
Yeah.
Somebody owns those. It's not Amazon. Amazon pays them rent. Amazon's not in the real estate business.
Okay.
And now, you and I can't go and buy and manage a giant warehouse for Amazon. But we could buy $1,000 worth of a real estate investment trust that owns that warehouse, a few other ones, some apartment, communities, and we're liquid. We can get in and out whenever we want. And we get passed through rent in the form of a dividend. And hopefully the share price will go up over time if the real estate investment trust called REITs, if they invest their funds wisely and go up. So almost all my clients own those in their portfolios. And that's the simplest way to do it. The first two ways, I would say can be more profitable, but take more time. And you also have some tax advantages by direct ownership of real estate. Okay. You can write off depreciation and effectively, not paying tax on your rent or offsetting the tax on the rent. So there's some tax advantages there. But I think it's a great way. I know people that have started by their first house was a duplex and they rented out the other half.
Right.
And then, they bought another one and another one. But just be prepared to be a landlord during that. And real estate can be good too because you can use, oftentimes you use leverage. You borrow to buy it. Mm-hmm. You can borrow to buy stocks, which is called margin trading. I don't advise that. It's aggressive because of the volatility of stocks. But borrowing to buy real estate, it's done all the time. It's a mortgage. And so you only put whatever it is, 10% down, and you get all the real estate. So if it appreciates, most of that money is the bank money that's appreciating. Mm-hmm. Long term, I'm not sure which wins in terms of returns. Real estate investment trusts as a group, the publicly traded ones, have done similarly to mainstream S&P 500 stocks. They oftentimes perform at a different time. So sometimes when stocks are going down, real estate's going up.
Okay.
And it's a great diversification tool.
Okay. All right. So wrapping up, what are some parting words that you want to leave us with and leave the viewers with?
So almost a year ago now, I think it was probably April of last year, we got the big drop during COVID. The S&P 500 went down 30%, and there's no vaccine. Everyone was, the numbers just kept going up, and I did a webcam, and I said, I know it's scary, but stick to the plan. And if you can buy some right now, quality stuff, it might take a year or two, but you'll be happy. It didn't take near that long, and we're doing well. Right now, it's easier to emotionally to want to start to invest than it was when I made that video, but I don't think your returns are going to be as good. We just had this big run. I'm not saying don't invest, just set your expectations down and, be prepared for some dips. We may have gotten a little bit ahead of ourselves with some of the optimism in some of these speculative areas. Mm-hmm. And don't own a bias of quality stuff and own the more speculative stuff as the dessert, not the main course.
Okay, very nice. All right, so how would someone, I know you have a very specific client that you deal with, but if somebody wanted to come and see if they were, in a financial spot that you could help them, how would they get in touch with you?
Absolutely. Call the office, email me, and I'll over the phone or Zoom chat with them for 15 minutes. Usually we can get a pretty good idea on if their situation fits what I would do. What my clients want, they want to delegate this stuff over to someone that they trust and someone that has experience and that won't screw it up. and it's not always about a minimum investment amount. It's more about that fit the first, that we want to delegate this over to a professional. And yeah, I don't know if you can put my information online, but yeah, just
website and everything.
yeah, just there's a link on my website to my email, phone number. I have a full-time assistant, Sarah, who's back there listening right now, and we'll just set up a consultation and see what happens.
All right, perfect. Well, thank you so much again, Eric, for taking your time out of your day.
Thanks.
We appreciate it. Everybody, that's a wrap. Short North Podcast. This is Sean Howard, Eric Thompson. Peace.